All right, so I welcome you all to today's session. Today we are dealing with corporate governance issues you must understand. What are the corporate governance issues you should know? What is corporate governance? Corporate governance is a process by which entities are being directed and controlled. This word is so heavy to the extent that people just use them like that. Today, let us understand the real meaning of corporate governance. Corporate governance. So if you want to explain corporate governance so well, we need to get it so clear that corporate governance goes beyond mere management. When you say governance, the word corporate means entities, entity. It means organization. It means there is a social arrangement made up of human beings. So the new Chinese entire machine factory may be limited, because it's full of machines controlled by another machine and controlled by only one human being. So we are talking about entity. Please, whether for profit, not for profit, for profit, we call them business entities, whether government, whether private entities, everybody needs governance. So the corporate here we are talking about, we are not talking about businessmen. No. In the house of the Lord, we need corporate governance. Everywhere corporate governance is there. So the corporate here means the entity. Then the governance. Governance. When somebody say governor, who is a governor? Governor. High commissioner. The word governance here means policies, directions, controlling, standards, principles, structures. That's all. So structures put in place in an entity is also known as corporate governance. You see, when you get corporate governance deeper, you will not struggle to make a definition. That is it. Now, let's now put these two words together. So corporate governance refers to systems, structures, policies, policies by which entities are being directed and what? Controlled. That's it. When we are talking about the direction, it's about policy framework. Policy framework direction. Controlled, it's about strong supervision. Supervision. Third party observation. Third party observation. That is what we mean by corporate governance. Now, corporate governance is made up of one. It includes, that means it has a lot of things. One, the institution of board structures, putting in structures such as what? Board of directors, board of directors, committees. It also includes policies, institution of policies, systems, procedures, and principles. These are governance. It also includes oversight. What is the meaning of the word oversight? It means supervision. The word oversight means supervision. Again, here you must understand that corporate governance deal with what you call institution of internal controls. You can never talk about corporate governance without mentioning internal controls. And one can. When we are through with corporate governance. So it goes beyond the mere definition. Please, corporate governance go beyond mere management. I always say this. In a video we shoot or we did in 2021, we made it so clear that there's a clear distinction between management. Today, I'm repeating it again. There's a clear distinction between management when it says someone is managing a company, and other one is also what? Govern a company. So governance go beyond management. So we can say corporate management and corporate governance are two terms relating to a corporate, but they are not the same thing. Corporate management and corporate governance are not the same terms. One is senior, one is junior. One is on top of the other. One look out for the general direction. One is being affected by the decision of another. So take notice of that. All right. So take notice of that. Now, what is management? It's concerned with running daily administration of the entity. What about governance? Governance is about long-term direction, long-term direction and control of the entity, long-term direction of what? Control. Management gets its feet or its authority from governance. This one, only governance practice would understand. From governance, it means that, you see, governance supervise, or they serve as oversight. They have oversight role on management. I want to create the distinction between management and governance so clear to you so that we don't mix them. Now, management implements the governance principles. Policies. Whilst governance create or develop the principles. So, if you talk about governance, that is what is. So that is what you have to take notice of that. Then I have what you call target corporate governance triangular theory. It's a new theory we have developed for corporate governance. G corporate governance theory. Now, this is what target is saying. Governance is all about three people. Ownership, investors. It can be institutional investors, individual investors, corporate investors, private investors, government investors, state investors, widespread investors. We are here. And they want someone to control. So control. And they give it to the board of directors. So board of directors. I call them the controllers. They control the company. So they have control. Then they look for management administrators. They manage the day-to-day. So I call them the stewards. So you see, there are three things here: ownership, control, and management. Know the difference between them. Ownership, control, and management. Now, ownership, the owners engage, the owners serve as a principal. They directly engage team, board of directors, call them agents, to control their company or their corporate for them. And the board also appoints executive management so that the management can also run the operations on daily basis on behalf of the board. So the management are stewards. So there's a theory called stewardship theory, which suggests that management are stewards. They only take care of assets. In the Ghanaian dialect or language, we call it Shesomami. So meaning management, they take care of the assets, they allocate assets, they are stewards. But what is the connection? So I use the broken lines to connect these people. There's no direct connection between management and shareholders. It is not a proper corporate governance practice. So ownership or owners don't have a direct link. The direct link flows from here. It can flow from here. It can also flow from here. It flows from here. It also flows from here. But here, no, it doesn't flow from there. In my triangular theory, I use the broken lines to do it. This is all what Target is saying. I use this triangle to explain what governance is all about. Governance is the forces. That this side of the triangle, push. There are some forces this side of the triangle push to this side. Forces this side of the triangle pushed here. So this is what you mean by governance, corporate governance. So that is why I clearly stated the difference between management and governance. So governance is what the owners and the board put in place to direct what the management will do. If you leave management alone, they are steward. If you leave them to take their own decision, their own discretion, by the time you realized, they will direct the entity towards a different path. So the overall direction is in the hands of the board. So understand this triangular corporate governance theory, that corporate governance exists when owners and the board direct their efforts and management to achieve the corporate aim. That's all about Target corporate governance theory. The theory further explains the role of ownership or investors in corporate governance. Their role is in the form of approval, such as what? They approve the decisions. The board of directors create decisions. They create decisions. They create the policies. They create the principles. They create the governance principles. They create the governance issues. So they take the decisions, and all the decisions, the material and then the central or fundamental decisions must be approved by the board, must be approved by the shareholders. Again, the management, they, in the form of what? The recipient, they implement the decisions. In this theory, though the theory is at its initial stage, subject to final publication, we will say that management implement the decisions of the board, which has been approved by the owners. So I can also relate this to a driver, car, and car owner. So who is the driver here? The board of directors. They are behind the wheel. The owner is the car owner. The one who received the action, the force, the pressure, is the vehicle. So all the frustrations of the owners are put on the drivers. Then all the frustration of the driver is also directed towards the vehicle. That is a corporate governance. So if you ask Target what corporate governance is all about, this is a summary of corporate governance. Now you're going to look out for the best practices. So we'll take first the board. So we are going to take our time and talk about the board of directors. The board. All what you need to know about the board of directors. Board of directors. Board of directors are made up of 2 members, executive directors and non-executive directors. The non-executive directors, there are 2. There are some versions of them, we call them independent non-executive directors. We have independent non-executive directors. Who are they? I'll take my time to explain. I'll explain the best practice for Ghana. And I know that it is applied to the international code, though there are some similar or little variations, but the code that we used are not entirely different. One, board of directors. In Ghana here, our best practice says the board of directors, the number, you can select any number of your choice. However, if the number fall below 5, if the number of directors on the board is below 5 or above 13, disclose with explanation why that number of directors. So indirectly, the code is saying that choose between 5 and 13. But in some cases where your board members are much more than 13 or they are below 5, just come and explain to us why you selected that number. For all you know, your size does not allow for you to select 5. The size, your size does not allow you to select the 5. A company like MTN, they are large. So I'm expecting them to have large board members. Company like Tesco is a giant company in the world. Amazon and Co. Apple, Benz, Toyota, and the rest. These are giant companies in the world. So I'm expecting them to have a large board and different complex board. However, if you are selecting board members, it must be based on 1, size of the entity. We don't just say that I'm selecting 5. No, please. Consider the size of the company. Number 2, consider the complexity. You consider the regulatory environment, the laws in that state can usher you to reduce your, for example, all banks in Ghana here, they are to select at least 5 members, maximum of 13 members. Banks cannot go beyond 13, never, even if you were listed. Currently, Ghana Commercial Bank, in their last annual financial statement, GCB, they are 13 in number. So to target, they have exceeded their limits. However, they could still increase it, even though it will go against Bank of Ghana's directive. However, GCB is a listed company, and the listed firms have to comply with the best practice for Ghana. So that is that. Again, you must also select members based on risk profile of the entity, risk profile. If the entity's operation is highly risky, you need to have a lot of non-executive directors. Because in a risky environment, the saviors are non-executive directors, especially the independent non-executive directors. Now let me go deeper. This is the very first series of our corporate governance videos.
This with the complexity. Is it the complexities of the business or the environment?
Both complexity of the business, how complex the business is, and the environment they are living. Imagine Russia wanted to attack Ukraine. Russia said, we are mounting a 1 week invasion. We'll squander, we'll finish Ukraine within 1 week. 7 days mission. And it is almost getting to what? 5 to 6 years mission. So it tells you that now the mission is complex. So therefore, the number of troops must be increased. So complexity here has to do with one, the operations of the entity. Operations like banks. Banks, if taking somebody's money, and you are going to invest the money, when you get the return, you come and share the return with the person. What if you go and the money get missing? Who am I going to call? When the person come back for his money, doesn't understand any language apart from recount the money at the counter. That's the only language the person understands. So that's the complexity we are talking about. And then the risk profile. Complexity in the sense that managing things, funds, liquid, money, it flows like money is something that it doesn't have legs, it doesn't have hands, but it can travel faster than human beings. That is the complexity of it. It can change hands easily. Operations, complex environment, such as what? Money laundering, such as what? Exchange rate regime, forex trading, such as the use of what? Systems. So that is the factors. Again, going back to storyline, you can also talk about the types. Now, executive directors are ordinary executives or their senior management, such as the MD or the CEO, the finance director, internal auditor, and then the rest. They may be part of the board. However, the non-executive directors have to be more. Have to be what? More. The non-executive directors have to be more. The board. And there must be a balance of executive directors and the non-executive directors and independent non-executive directors. So I'll take my time to explain whom each one of them they are. And I'll tell you how Ghana, our best practice says. First, executive directors are just normal employees. They are just the head of the management team that I talk about. When you say non-executive directors, non-executive directors, non-executive directors,
Kindly take the executive directors again.
Can you come again?
I was asking that you take the executive directors again. You said
They are the executive management. They are the senior management. So if you take a company, simple structure, MD, also known as what? MD or the CEO, managing director, or CEO, CEO. Then sometimes they have deputy. And some of the organizations have 2 deputies. Some have 3. Some have 3. We have deputy executive director, operations, we call it ops. Deputy director, deputy executive director, we call it admin. Some of the entity, they put admin and finance together. Administration and finance. Some of the entity, they separate it. Admin is different from finance. The big company, the giant ones, admin is different from finance. You can't combine them. If the company is about, let's say, banks or company that they have a lot of laws governing them, any company on earth that they have a lot of laws governing them, they should have what you call a deputy executive director in terms of compliance. Then under them, they also have different functions. So under them, we have maybe production, or if it's a bank, they'll say credit, or ACO. Credit, a bank will use ACO, asset and liability management. Asset and liability management. They'll have a department called admin. We have what you call internal audits. We have account and finance. Then we can have marketing. So all this, they report to one of this. Also have their head. It goes down. So if you are talking about executive directors, MD is number 1. Most often, MD will be on the board. So if MD go and sit on the board, MD is a board member. We will call him an executive director because he is an employee of the company, though he's a chief employee. But at the same time, he's on the board. We can decide to pick the internal auditor or the head of finance, chief financial officer, CFO, or the finance director, or we can pick the DED, admin and finance, should be on the board. Or let's pick compliance. One of them should be on the board. Or all this, no deputy should be on the board. Let the MD and chief finance officer or internal auditor be on the board. So when any of these team members are on the board, they are called executive director. If any worker of the company is on the board, you are called an executive director. But if you are not on the, you are on the board, but you are not with the company, You are not with a company. You are not a worker. You are not a daily worker. You are outsider. You are called non-executive director. Non-executive director. You are non-executive. I call them the police. The police people. The police. The decision makers. The challengers. The experts. They are supposed to be experts. They're independent. I'm done. So now, and again, they are called non-executive directors. They are outsiders. They don't work for the organization. In Ghana here, the best practice for Bank of Ghana released a directive. You can never be a non-executive. And if you are the employee, a past employee, unless it has been 2 years or more. So if I either retire or I've worked with any bank, I can never, they can't appoint me to be a non-executive director until 2 years has come and passed. 2 years. I cannot be a non-executive director. After 2 years, that one I can be. Then, in the non-executive director, the outsiders, we have some that are independent. We have some that are what? Independent. Now, let me explain this deeper for you.
Please, start again because the 2 years thing is a bit confusing.
This is very straightforward. For example, I retire today. Today's date is
19th.
19th of October 24. This is my retirement date, or this is the date I left the company. Today I left the bank. Let's say I've left Target Universal Bank. Today I've left this bank. Bank of Ghana is saying that whether special skills I possess, whether I'm the best, whatever, this bank cannot appoint me as a non-executive director onto their board again until 2 years' time. So calculate for me, 19th October 2024, exactly 2 years later will be when?
19th October 2026.
19th of October 2026. After this day, they can appoint me as a non-executive director. In between, I can never, when I come there, it's against Bank of Ghana's code. Agreed.
But I'm trying to build an understanding that with the non-executive directors, essentially they are not members of the organization.
They have to be independent to the extent that they shouldn't have any business dealing because the person just worked there. And the person did a very bad thing. For example, the person, there are certain transactions the person was involved about 6 months ago. And now the board have got notice of it. And they are talking about it. You are the chairman of that committee. How will you feel? You will see wrong as right. You won't be able to chastise your work because you have worked with them. You will know the in and out. So for 2 years, after 2 years, the matter will go and die. If you are involved, we'll handle you well. Then if you are not involved, later you can come and then join the
If I understand well, then the issue is that the non-executive directors can be an employee who has retired. That's after 2 years before he can be appointed.
Yes, please.
Okay.
That is the Bank of Ghana. Great. Now, what happened is that, but any other person can be a non-executive director, but the person has to be skillful. Especially, I'll give you the requirements. I'll give you the requirements. I'll write now all the requirements necessary. And please, all those, there's a particular position reserved for a chartered accountant, that's the chairman of audit committee. Any institution in Ghana here must be a chartered accountant, the chairman for the audit committee of anybody in Ghana. The chairman has to be a chartered accountant. If you are not, you don't qualify. So all the companies in which the audit committee chairman are not chartered accountants. Wake up call. All right. Now, the code may be so clear that, now let me complete that of the independent. Let me also explain this. Who can bring someone onto the board so that who can appoint a member onto the board? Members can be appointed and be elected. Members can be appointed, elected. Who can do that? Who can appoint? Who can elect? One, shareholders, the board of directors, the board of directors, they can appoint new members onto the board. They themselves can appoint new persons. So the non-executive directors among the directors can appoint new ones. So if a board of directors is being appointed, if the appointment is done by shareholders, it's not an independent. Shareholders. So shareholders can appoint non-executive directors. Let me make it so clear here. Shareholders can appoint non-executive directors. Non-executive directors. Shareholders can appoint them. So we call them normal non-executive directors. They are called just non-executive directors. They will never be independent. They will never. Anybody shareholders bring is working in the interest of his master. That's why at the political grounds, when any political party win power, they appoint people to fill certain key positions. And those people they also leave not to disappoint the one who appointed them. However, what if, usually normally by voting, but if we appoint directors not by shareholders, but based on experience, that one is the board of directors that appoint such person. By board of directors. And it's based on what? Experience. It's based on skills. It's based on what you have. Your qualification. Qualification. Then such person is called independent. We will add the word independent to your name. Independent. independent, non-executive director. So even the non-executive, there are two types. We have the one that are independent. Shareholders can bring someone outside their team members and join the board. No wahala. That one, we will still call him non-executive director because he's what? He's not working in a company. We understand. But the mere fact the shareholders brought you, you can never be independent. Take notice, you can never. When your other colleagues are taking decisions at the disadvantage of that shareholder who brought you, you will stand against it. You will not understand. But some directors are on the board by their qualification, experience, and their skills, not by shareholders' appointments. Such people are independent. And every board have to do everything within their powers to protect this. We call it's a treasure. It's a gold. It's something good. It's something that every board must hope to have. Because for them, they have no business relationship. They shouldn't have any familiarism, no familiar. They shouldn't know anybody. They shouldn't when I say no, they shouldn't have any relationship, business, interest, financial, non-financial. No. That is all. Now, let me tell you how directors must be appointed. We appoint directors based of skills, qualification. So board of directors should be appointed based on skills, qualification, experience in the angle of finance, angle of accounting and audits, angle of law, compliance, angle of risks, angle of industrial experience, industry. So if it's about bank, we need a retired banker, someone that has been in the banking field for long and have all the risk expertise. As soon as the person enters the banking hall, he can sense that somebody is doing things that are not right. He can sense that somebody is doing things that are not right. That's all. Risks, industrial, law, compliance. The industrial, you can have credit and the rest. Now, let me tell you the composition, the perfect composition for companies in Ghana here. The board should comprise of both. There must be, first, the composition should be in this form. When an examiner asks you to talk about composition of the board, your first statement should be like this. The board should have a balanced number of executive and non-executive executive directors. So a board with only executive directors is also not good. A board with only executive directors is the worst board ever you can ever get. A board with no non-executive is not good, at least. Even if it's not good, it can be the best. But the board with only executive directors, the board with only executive directors is one of the worst boards you can ever get. It's a waste of time and waste of money and resources. They should dissolve that board immediately and find something else to do. It is worse. There must be a balanced number of these two people. Now, let's make these things clear. Yeah. Now, when I say balance of executive and non-executive directors and independent non-executive directors. When I mention independent non-executive directors, I'm very happy because I'm taking my time to explain who they are. They are the directors we appoint on the board, not by shareholders' appointment, but rather based on their qualification, their skills, and their experience, what they have within them. That made us call them. It's not the mouth they can talk. It is not political appointees where that for them they have mouth to talk. They can defend the party very well. So these are the people we appoint as leaders. No. Over here, based on technical skills, there must be a balance. Point number two, tell the examiner that the majority of the directors shall be non-executive directors. Majority. Majority shall be what? A non-executive directors. So here I understand. Majority shall be non-executive directors. Now, the third point will shock you. The third point will shock you. Or the second point. Majority of the non-executive directors must be independent. Majority of the non-executive directors must be independent. Majority must be independent. Again, let me go one step again. At least at least minimum of 2 directors. Must be independent. Normally write it this way. This one means independent, non-executive directors. And one of whom may be the chairman. One of whom may be the chairman or chairperson, chairman of the board. So listen,